So why is it possible that two unfortunate events or different types of monetary events happen that are treated as equivalent in terms of value, lead to the two different outcomes? This is what we're going to look at into this concept of mental accounting. So let's start this story with two different scenarios. First scenario is you buy a $100 ticket to a show, and once you get there, you realize that you lost your ticket. You also realize that there's more tickets available equivalent to the one that you have. Do you buy an extra ticket? Or perhaps, on the other hand, you're walking to this show, you get there, you realize that you lost $100, you haven't purchased a ticket yet. Do you now purchase a ticket? Well, in the situation where people walk to the show, realize that they lost their ticket, most people would not buy a new ticket. And in the case where people are walking to the show, realize that they lost $100, they would still end up buying the ticket. So why is that the case? Well, there's this whole concept of mental accounting. This whole concept of mental accounting means that we're categorizing the amount of money into different categories. So we can have a certain category that's entertainment, one that's based on like food and shelter, another one that's based on sports, and so on. And we have all of these different categories. And in the first example that we had, we paid for the entertainment category. We realized that we lost a ticket, and then we paid more into the entertainment category. So it gives us the impression that this show didn't cost us $100, but in fact cost us $200, and we don't feel comfortable in paying $200 to see this show. So a lot of people would back off. Whereas in the separate situation, we lost $100, which was $100 general money. It could have been used for anything, but we didn't yet spend on this entertainment. So we don't necessarily associate it. Let's say you had several $100s in your wallet and you realize that you lost one of those 100. Well, you would still buy it because that entertainment category, you wanted to see the show, you're ready to pay $100 for it. You don't feel like you've overpaid. You feel unlucky about losing $100, but you've just paid $100 to see the show. So even though both of them are equivalent in the sense that you were unfortunate and you lost something that's worth $100 in that given day, both of them lead to a situation with a different action. So would you buy a $25 sports ticket if you already bought a $50 sports ticket? How about if you've bought $50 worth of food, or $50 worth of supplies, or $50 worth of medication? Well, in all of those situations, you've already spent $50, but in the first situation, that initial $50 was already in that kind of entertainment, gifting yourself. So you're less likely to spend $25 more on that sports event. So we always like to gift ourselves, but if we've already bought something to treat ourselves, or we're already paid for a vacation, we're less likely going to gift ourselves in the immediate versus if we've spent money on things that we had to purchase for the house or for our health and other reasons, just because we like to separate money in different categories. So what we say here is that there's different categories and money doesn't really transfer easily in our heads between these categories. They're seen as non-fungible. So we have these different categories where this money is allocated to this fund, this money is allocated to this fund, this money is allocated to this fund. So here we're just looking at one income source and how we're allocating our expenses. Sometimes we would say that if you're giving something to someone, cash is always the way to go because cash is, they can do anything with it. And they were wondering about this when like different recessions happen, whether they should give cash or whether they should give food stamps. And in the end, they often gave out food stamps, historically speaking, because they found that giving food stamps led to people spending more on food. They were putting that money in the category that they were subject to putting it in versus having a situation where cash could lead to anything. They could lead to paying something off or buying themselves another product. So sometimes forcing people to behave in a certain way can be good, because otherwise if you give them too much liberty, they won't. But if you think about giving a gift to a friend, I personally prefer cash. If you want to give me money, no, just kidding. But I personally prefer cash because of its flexibility. I feel I don't lose it. But let's say I'm well organized and that gift certificate that you gave me, there's no way I could lose it. It's like online and so on. Well, the beauty of the gift certificate is that you'll have a situation, let's say for their birthday, you gave them a $100 gift certificate to a store that they enjoy. Well, you know that they're going to treat themselves. They're going to gift themselves with that money. Whereas if you give them $100, they might just put that $100 on their mortgage, on their student loan, on something else, which won't give them as much satisfaction. So if you want them to put that money towards a certain category, gift certificates were an interesting tool for that reason. It really helps out. So sometimes we want to tailor our gifts so that people buy in a certain category, whether it's for them to be more satisfied, to be happy because it's their birthday, or they've just gone through a really big event. And sometimes we want them to act in a certain way. And then there's the whole idea of how do different income sources actually get divvied up? Because if I think about a person making a $100,000 salary, well, he'll divvy it up in different categories. But what happens if that person gets a bonus or wins like $10,000 with the lottery, or gets a bonus from the government? Many years ago, the Alberta government sent out a check for $400 to all its citizens. Well, what do you do with that extra unexpected income? Do you spend it the same way as all your other income before? Not necessarily. When it's unexpected, sometimes people will have a higher tendency to treat themselves to it because they're already living with everything else and they just had this extra income, so they see it as a gift and they're going to gift themselves more, higher proportion. They don't feel like they need to pay out the house because that's already kind of taken care of or planned for in their normal salary. So having these extra amounts of income could lead to different behaviors with that money than just receiving that money within your own normal income. Same thing happens with when income tax season rolls in. If you actually get an income tax return, you might not spend that money the same way as you would spend income that you receive every 2 weeks in your paycheck. So it's just things to consider, how people separate their spending in different categories. And if you want them to treat themselves more, or you want to encourage people to kind of gift their friends, how they can do so, and giving them extra tools. So the gift certificates kind of got created by that reason. So just try to think of different tools that you can create to help out people, and just try to think about your own behavior and how you consume and how you decide how much money is allocated. Like I have friends that, let's say, they stop mountain biking, or they realize that it's really easy to sell their mountain bike and they won't use it in the next few weeks or months, and they decide to sell it. The big thing that some people have told me as a mistake in those situations is that they didn't buy another one rapidly with that same money, because if they just put that money into their general income and just put it towards their mortgage, then it hurts a lot more to re-spend that money onto another bike that they have, even though it might just be a small upgrade, a few extra $100. But because now they have to take that money out of their general money, and it seems like a big gift to themselves, it's harder. So a lot of people have a tendency that when they sell something that they see as a entertainment perspective, travel or sports oriented or something along that nature, they like to, if they make money from one of those sales, they like to rebuy something in that same category quickly, so that they don't put that into general money and then make it painful for them to take that money out to gift themselves in the future. So just a bunch of different things to consider on how you behave and how you separate your money yourself, and how that could be applied in different scenarios in real life. Hope you guys enjoyed this video. I'll talk to you soon. If you found this video interesting, please consider subscribing or joining my class, where I guide you to apply and expand on the information found in these videos to real life examples. Have a good day.